Good evening and welcome to our fourth quarter financial market update call at Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call Cross Currents. The call tonight is being recorded and will be on our website, greatlatesprivatewealth.com, shortly afterwards. Now, let's get into what happened in the market in the fourth quarter and what we see going forward. Pat Patin will give us some data, and then I'll update you on my outlook for the markets.
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I begin, I must remind everyone that past performance is no guarantee of future results, and all information we will be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. Starting off with some key stats for our call, last year in 2023, the price return of the S&P 500 was up 24.2%. The Dow Jones Industrial Average was up 13.7%. The Russell 2000 was up 15.1%. The NASDAQ Composite was up 43.4%. International stocks represented by the EFA index were up 18.2%. Gold was up 14.6%. And bonds represented by the Bloomberg Aggregate Bond Total Return Index were up 5.5%. Over the last several quarters, the investing community has been highly focused on artificial intelligence and the stocks dubbed the Magnificent Seven, which we've mentioned several times in our past calls. Since the start of 2024, the Magnificent Seven have already gained a combined $540 billion in market capitalization, compared with a total market capitalization gain of $803 billion for the S&P 500 through Tuesday's close, according to the Dow Jones market data. Some members of the group, including the high-flying artificial intelligence darling NVIDIA, have seen their shares gain more than 25% this year already. By comparison, the Magnificent Seven added a total of $5.1 trillion in market cap in 2023, while the S&P 500 added $6.5 trillion as a whole. To start the year, NVIDIA and Microsoft have dominated investors' interest in artificial intelligence, with both companies seen as leaders of the AI boom. While small-cap stocks are viewed as needing lower interest rates and a higher growth environment to prosper, these mega-cap tech companies are viewed as better positioned to succeed in any environment. While we've spoken several times about the Magnificent Seven stocks compared to the rest of the U.S. stocks, we haven't spoken about the difference between U.S. stock markets and the rest of the world. While the S&P 500 has made several new all-time highs to start the year, many other countries' stock markets continue to lag well behind the U.S. In fact, the Magnificent Seven, as you can see if you're on our video portion of the call, there's a chart here, and for those calling in, a recording of this call and the charts will also be available on our website this week. You can see that many of these countries' stock markets are smaller than the Magnificent Seven in value. While we have remained overweight U.S. equities, international stocks have struggled over the last decade plus. Over the last 16 years, the U.S. stock market, represented by the S&P 500, was up almost 407%, while international stock markets were only up 84%, and emerging market stock markets were only up 38%. To detail this further, when comparing the U.S. to the second largest economy, China, over the last 10 years, the U.S. stock market is up 207%, while China's stock market in U.S. dollar terms is actually down 23%. Yes, that's correct. They're down 23% over the last 10 years. 3 straight years of losses have wiped more than $6 trillion from the market value of Chinese and Hong Kong equities since their peak in 2021. The struggling market reflects the concern about China's economic slowdown and the ability of the government to guide the nation out of a deflationary trap and a property crisis, coupled with the loss of confidence from many foreign investors. Investors have looked at China as undervalued for several years now, but it has remained a value trap. In fact, going back 27 years to 1997, the Chinese stock market, represented by the Hang Seng Index, is down. All of this while China's economy has grown 18-fold since then. This is quite an incredible stat. While the GDP of China has grown 18 times, its stock market is down over that same period of time. This is just another example of how growth and expectations of an economy or a company don't necessarily mean growth of your capital. We were quite pleased with our portfolios and the market results during the fourth quarter and all of last year. These were excellent times for most markets, especially in the U.S. And Dan and I continue to watch the cross currents in the data and expectations of investors across companies, sectors, and economies. We will continue to keep our finger on the pulse of the markets and update the portfolios and you, our clients, accordingly. And with that, I'll turn the call over to Dan for his market outlook.
Thank you, Pat, and good evening, everyone. What a great fourth quarter it was. Anyone who knows me knows I'm not one to boast or brag, but tonight we're going to brag just a little bit. I'm going to paraphrase Dan Campbell, the coach of the Detroit Lions, and share some of his philosophy. First, I have a heck of a team that I'm a part of. I get comments all the time how great each and every one of the people on my team are. These compliments come from the most important people, and that's you, our clients. And I want to thank you for the kind words, and I must say how proud I am of the effort my team puts in every day to make our clients' lives better in so many different ways. The second thing I want to point out is what a great performance we had last year. Many of our accounts did exceptionally well, and we bested most of the benchmarks we are measured against. This only happens because of everyone on my team's commitment to working hard. As any good leader knows, we will never rest on our laurels, and I think great performance and execution doesn't just happen because we all know that's not the case. We know we must continue to bring our A game every day, and I promise you we will. So thank you to my team and their dedicated effort to me and to you, our clients, every day. Now let's talk about what happened in the fourth quarter of 2023 and what I see going forward for 2024. As I mentioned, tonight's call is titled Crossed Currents. Most of you know on my last quarterly call in early November, I was very bullish on the market. We added money to the market in October because of my belief that the Federal Reserve was done raising interest rates. It was my experience, along with our data from many of our indicators, that signaled we were about to have a very nice rally in the stock market. Not only did the market rally, it was one of the strongest fourth quarters the market has ever experienced. Now, tonight's call is titled Cross Currents. In early December, we had a very overbought market, and many of our indicators were now indicating cautiousness. We started to reduce our exposure to the stock market accordingly. The question I'll answer tonight is, are we still cautious? And what do I think is going to happen for the balance of this year? The number one thing that drove the stock market in the fourth quarter of last year was the stock market's anticipation of lower interest rates after having seen the Federal Reserve raise rates at an unprecedented rate in 2022 and 2023. The other factor driving the stock market was the potential of lower inflation in 2024. Since the lows in October, the stock market as measured by the S&P 500 is up almost 20%. Surprisingly, this all occurred without the Federal Reserve lowering interest rates even one tick. Much of the gain in the stock market was predicated on the Federal Reserve starting to lower rates by March of 2024. Many economists and market strategists predicted that there could be as many as 5 interest rate cuts in 2024. Well, when we look at what the odds were from the chart, and again, as Pat said, some of you that are online on your computer, you'll see the chart. If not, it'll be up on our website very shortly after the call. But you can see from this chart, it shows the probability of the Federal Reserve cutting interest rates. And on January 1st of this year, the odds were close to 88% that we would get a cut. Today, the odds have been reduced to only 35% that the Federal Reserve is going to cut rates in March. I consider this the first cross current for the market. The market has rallied so much without even an inkling of an interest rate cut as of today. In fact, I believe they will not cut rates until sometime late in the second quarter, and it's even possible it may not happen until the third quarter. With the impending presidential election this fall, the Federal Reserve typically does not want to change interest rates up or down as we get closer to the election. You ask why they don't want to lower rates? Because they don't want to have interest rates potentially influence the outcome of the election. So if we do get a cut in rates before the third quarter, the Federal Reserve may not want to cut them, and they may wait until after the election in November. Again, this is my second cross current. If rates stay at these levels, the market will most likely sell off and adjust to the fact that interest rates are going to stay higher for longer. And this is not something the stock market or the interest rate market has been anticipating. Last Thursday, the preliminary fourth quarter GDP came out and showed the economy grew at 3.3%. If the economy is doing so well, how in the world is the Federal Reserve going to justify lowering interest rates at this time? The employment rate that was reported in the first week of January showed an additional 216,000 new jobs were created in December. Yet, we have seen many major companies announcing layoffs. As an example, Levi Strauss is cutting 10% of their workforce. Citigroup is laying off 20,000 employees. These are not small numbers. And just today, UPS, the delivery company, mentioned 12,000 employees. Microsoft, 1,600 employees. The list goes on and on. And this is just in January alone. If business is so good, why are companies laying off employees? This is cross current number 3. As you can see from this chart, it talks about, again, profit margins. One of the reasons companies are laying off employees and cutting staff is to maintain their earnings. This means protecting profit margins. With inflation still rising, one way to keep profits from falling is to manage operations with less employees. The cost of materials and goods and labor have all gone up dramatically over the last 12 to 18 months, and companies are raising prices. The problem is companies are struggling to raise prices fast enough to keep pace with the inflation they're experiencing. So again, something has to give. Either the economy is slowing and these companies are correct in laying off employees, or business is good and they're doing it to make sure they continue to protect their profit margins and earnings going forward. My guess is it's a little bit of both. Now let's talk about inflation. As you can see from the inflation chart here, the CPI, when it was reported in January, showed inflation running at an annual rate of 3.4%. It was 0.2% higher than most economists had predicted. With the fighting going on in the Middle East between Israel and the Palestinians, any normal person would have thought oil prices would have skyrocketed under this scenario. We also have the Russian-Ukraine war and the embargo against the use of Russian oil. We now have ships being attacked in the Red Sea, which is a major shipping lane for goods and services, along with oil and gas. It's hard to believe that just a few weeks ago, oil prices were near two-year lows, trading below $70 a barrel. I was in Houston, Texas 2 weeks ago, and a gallon of gas was, believe it or not, $2.59 a gallon. Again, if the economy is doing so well, you would expect the demand for oil to be much higher and prices to go up. Even without a super strong economy, you would have thought with the Middle East conflict, oil prices would have skyrocketed. This is my fourth cross current. Inflation from energy is non-existent at the moment. I'll say that again. Inflation from energy is non-existent at the moment. This can change in an instant and very quickly. Now, this conflict in the Middle East has caused another major issue for anyone who ships through the Red Sea and the Suez Canal. And it's caused a lot of companies to either cancel or reroute shipments. This is important because it's adding to shipping costs. The chart we're showing on the screen is showing that. And you look at shipping costs, the Drewry World Container Index has more than doubled since late last year, and it is taking an additional 10 days to get goods because the ships have to travel an extra distance by going around the southern tip of Africa. Approximately 25 to 30% of global container shipping volumes pass through the Suez Canal. We don't know at this time what this will do to the supply chain or inflation, but I can certainly tell you that neither is a positive for companies that ship through the Suez Canal in the Middle East. Again, this is another cross current. I'm constantly asking myself and my team, what would have to happen to allow the Federal Reserve to lower interest rates? Let me share with you what the chairman of the Federal Reserve has said publicly, what it would take for the FOMC committee to consider lowering interest rates. First, inflation has to approach their long-term target of 2 to 2.5%. We are certainly trending that way, but we're not there yet. Secondarily, they need to see employment trends soften along with wage inflation. So we have price inflation trending in the right direction for sure, but wage inflation is not slowing down. Employment trends or job creation, as we saw last month, were much higher than anyone predicted and are actually showing continued strength, not weakness. Another cross current. Hiring, spending, and interest rates are all somewhat correlated. We know rates are certainly much higher than they were during the 2020 low after the COVID pandemic. Let me give you some perspective from this chart that gives you a historical point of view of where rates have been when it comes to mortgages over the last 50 years. In the 1970s, rates on home mortgages averaged 8.9%. In the 80s, the average was 12.7%. And in the 1990s, 8.1. In the 2000s, 6.3. And in the 2010s, they averaged around 4.1%. And so far in the 20s, the average is 4.6. The lowest rate was in January of 21 at 2.65%. And the peak so far in the 2020s is October of last year at 7.79%. Today, the rate is 6.69%. Now let me share where I think interest rates are headed and when. The Federal Reserve has raised rates from zero a year ago to currently 5 to 5.25%. If they start to lower interest rates, this could get the economy heating up again and cause inflation to tick even higher due to increased demand for goods. The Federal Reserve would then be forced to raise interest rates even further. In my opinion, if the Federal Reserve did raise rates, it would cause a substantial drop in the stock market for two reasons. First, it is the last thing the market is expecting at this time, and that's for interest rates to go up. The stock market does not like surprises. If interest rates go higher, why would anyone take the risk to invest in the market when you can get a very substantial return on fixed income safe investments? This is a classic risk versus reward analysis. Institutions would sell immediately, and this would also lead to a sell-off in the market. In short, until unemployment really starts to soften and inflation is totally dead, I don't believe the stock market can go substantially higher from here, and in fact is very susceptible to a short-term decline if the economy strengthens from here. On several of my last calls, I've said the Federal Reserve will not make this mistake by lowering rates too early, and this is still my belief. They will not lower until the economy is softened and inflation is dead. Now, one little nuance I would say is, if we all remember in January, we had a lot of cold weather and canceled travel. So you may see in the next couple of weeks some indicators showing the economy is actually softening due to the weather problems we had in January. But I think once we get past that, when March starts to, the data for February and March comes out, it'll show the economy strengthening, and the potential for an interest rate cut in March will be taken off the table. So in summary, I believe we're in a stalemate at the moment for the market until we get some real clarity about employment softening and inflation falling further. As I've mentioned on several calls, that during a calendar year, the stock market on average experiences a correction of 14.2% from its high to the low. This can happen at any time. This 14% drop has occurred even with annual returns being positive 33 of the last 44 years. So again, I don't expect this year to be any different than any other year. And most likely at some point during the year, we'll see a drop, which goes with the average of around 14.2%. Now, in 2024, we have a presidential election. It appears at the moment it'll be a rematch between President Biden and former President Trump. I'll share some facts with you about a typical election. As you can see from this chart, the average return on the S&P 500 during election years is 6.8%. If the incumbent is a Democrat, the average is 10.1%. And if the incumbent is a Republican, the average return is 3.9%. Over the last several years, though, the actual results have been dictated more by the direction of interest rates and how the actual economy was doing. Now, I'll talk more about the election on my next quarterly call in April and July. So much can happen between now and then, so I'll just leave this alone for right now. This data, of course, is provided by Bespoke Institutional Research, which we're subscribers to. The biggest investment frenzy right now, though, is AI. That stands for artificial intelligence. This is what every client is asking about and is a part of almost every investment news story. How can it not be when a company called NVIDIA, the leader in semiconductor chips used for AI, has a market value that has gone up $840 billion in just 3 months. NVIDIA is worth more than Costco and Walmart combined. I want to give you 3 examples of some other companies that experienced crazy increases in market values over very short periods of time. The first example is Tesla, which between July of 2020 and September of 2020 saw its market cap increase from $180 billion to $460 billion in 3 months. The second example was during the meme stock craze in 2021 for a company called GameStop. GameStop rose in market value from $500 million to $53 billion in just a few weeks. And the last example is Zoom Video, which from March of 2020 to June of 2020 went from 29 billion market cap to 151 billion. This is starting to remind me of the late 1990s and early 2000s when we had what we called the internet bubble. Back then, everyone knew the internet was going to be transformative, and it certainly has become that. It was a game changer of almost unthinkable proportions. I've shared the story many times about when in 1999, when I was managing money, I sold a stock we had bought in the 20s. We sold Yahoo at $175 a share. Right after I sold it, of course, it went up to $250 a share in just a couple of months. Now, remember, this all happened around the year 2000. Again, we refer to this period as the dot-com bubble. Well, lo and behold, in 2021, Verizon bought out Yahoo at $42 a share. So to summarize what happened, did the internet take off? Yes. Was it bigger than anyone thought? Yes. But was Yahoo at $175 or $250 a share a good price to pay for it? Clearly not in hindsight. Now, you probably think I'm just cherry picking using Yahoo, but I'm not. Who remembers a company called Cisco? Well, they still exist. In late 1998, they were the #1 modem maker. This is what allowed your computer to connect to the internet. In 2000, Cisco was buying companies that had anything to do with the internet. It was one of the darlings of the internet investing back then. How well has it done since then? In March of 2000, Cisco was trading at $82 a share. Today, it's at $52 a share, 24 years later. The reason I point this out is when we get into these periods where it appears that any one particular stock is the quote unquote can't miss stock, no matter what it's worth or what it's trading at, you have to be careful. We've all heard of Tesla. This was the only EV stock and the only game in town in October of 2021. The stock at the time was over $400 a share. Today, it's worth $188 a share. At the beginning of last year, in January 2023, it was trading near $100 a share. That's a drop from its high of almost 75% in 2 years. They were building cars in Europe and China, but do change. In the final quarter of last year, a Chinese company, BYD, overtook Tesla as the #1 EV maker in the world. I'm only providing these examples just to point out that I believe AI is transformative technology and can help in many different industries. There can be no denying that. How is AI going to help us? I'm going to share with you a couple of examples of the power of AI. With the mania of electric vehicles, one of the key things you need to make an electric vehicle work is a battery. And the batteries use something called lithium. Lithium is an element that's not in massive supply everywhere in the world. Until recently, it was trading at very high levels in price, and some people thought that the lack of supply would end up hurting the potential growth in the EV market. Well, guess what? Some scientists put AI to work to find out if there is any other material with all the characteristics of lithium that could be used as a substitute. And guess what? AI came up with an alternative in 7 days. That is amazing. And this is just one example of the power of AI. Let me share another example of the power of AI. One of the biggest potential benefits is to help people stay healthy so they don't need a doctor, or at least not as often. AI is already being used to detect diseases earlier and with more accuracy. For example, AI software can interpret mammograms, translate patient data into diagnostic information to determine breast cancer risk 30 times faster than a human doctor with 99% accuracy, reducing the need for unnecessary biopsies. So yes, AI is going to be able to solve many very complex problems in a record amount of time. This is very exciting indeed. But as investors, we must be careful when making investments to stay focused on the long-term potential and ultimately the company's profitability and earnings power. Let me shift gears. Let's talk about some of our key indicators and where they stand at the moment. First, as I mentioned in early November last year, sentiment is measured by many key indicators we use was near extreme fear levels. That was a clue for us not to get too negative on the stock market. Yesterday, the CNN Fear and Greed Sentiment Indicator was at 78, which is a reading of extreme greed. Again, extreme greed. That historically does not bode well for the stock market over the coming months. This aligns perfectly with our Ned Davis Research key sentiment reading at a level of 78.8 today. Since 1994, whenever this indicator is above 62.2, the market has had an annualized return of negative 5.4%. And if we look at the indicator's results since 2006, the annualized return when the indicator is above 62.2 gives us a negative market return of 2.52%. So both of these are negative at this time. We have another indicator that looks at the overall health of the stock market by taking into account many different indicators, and we come up with a total score. The data on this indicator goes all the way back to 1979. It is currently positive, but it is weakening. Whenever it's positive, but it's weakening over a 5-week period, the annualized return is 7.04%. So in general, we have a very overbought market. CNN Fear and Greed is at extreme greed. We have our internal signals are weakening. The current rate on the 6-month Treasury bill today is 5.2%. We must always analyze whether it's worth taking the risk in an investment when a risk-free investment like T-bills is returning over 5% currently. I'm going to talk about three indicators that have been around for a long time that help give us clues to how the market may do in the following year. The first, you may have heard of, is the Santa Claus indicator. The second indicator I'm going to talk about is the beginning of the year indicator. And the third indicator is called the January barometer. Here is how we look at each one. The Santa Claus looks at the last 5 days of the previous year and the first 2 days of the new year. The beginning of the year indicator looks at how does the market do in the first 5 days of the new year. And the January barometer looks at how the month of January as a whole does. Per Ned Davis research, when all three have showed a positive result, the returns for the market have been strong. The S&P has risen 87% of the time from January 31st through December 31st by a median of 13.3%. The trifecta indicator proved to be accurate in 2023, as over the 11 months of the year from January 31st to December 31st of last year, the S&P rallied 17%. Well, how are things going so far this year? Well, the Santa Claus indicator is down. The first 5 days of January, the market's down. So 2 out of 3 are down. Through yesterday, the S&P is up 3.35% year to date. What's interesting is over the last 95 years, there's only been 4 times when the first 2 indicators have been down and the month is still higher. This is another cross current, and unfortunately, it's a small data set to be able to glean great insight into what to expect for 2024. I mentioned tonight's call called cross currents. I've highlighted several of them for you tonight. So let me summarize where we are at the moment. First, the market's overbought and extended. CNN fear and greed is at extreme greed level. The Federal Reserve has not begun to lower interest rates as of today, and I do not see them doing so anytime in the next 3 months based on the current set of data we're seeing in the economy. Inflation has fallen, but needs to fall further, closer to the Federal Reserve's target of 2 to 2.5%. The unemployment rate is near a record low of 3.7%. Employment trends are strong and do not appear ready to decline in any material way anytime soon. For the markets to move much higher, we need lower interest rates, stronger earnings, and a stable geopolitical climate. Until we clear up these cross currents that exist, the market at best will go sideways, in my opinion. And at worst, we will have a sell-off in stock prices. We will continue to monitor all these factors to help us make the best investment decision possible for you, our clients. In closing tonight, I want to reiterate what an exciting time it is at Great Lakes Private Wealth. We're continuing to grow, and we owe a debt of gratitude to you, our clients. We've expanded by opening an office in Florida. Many of you have been with us for decades, and we've protected and grown your capital over the years. We like to say we have a maniacal focus on picking the best investments for you while providing first-class service. We're excited about the opportunities in the future, and I want to thank you for referring your friends, family, and colleagues, and again, just say thank you again. We have many new ideas for the coming year. This includes possible webinars on subjects like Social Security planning, what's the best Medicare coverage plan, and also hearing from key leaders and authors on various subjects. Please be on the lookout for a survey our team will be sending out as we gather more insights for our future events, informational sessions, and exciting activities. I want to thank you again for joining our call and have a great evening. Good night.
This presentation is for informational purposes only and is not an offer or solicitation to purchase or sell any security or to employ a specific investment strategy. It is not designed for or individually tailored to any particular investor and is not intended to be suitable or the best interest of all types of investors. This information should not be relied upon as research or investment advice and is strictly for illustrative, educational, or informational purposes. Opinions expressed in this presentation are subject to change without notice. There's no guarantee that any forecast made will be realized. Past performance is not a guarantee of future results. Investing involves risk, including the possible loss of principal. Index performance is for illustrative purposes only and does not include dividends unless otherwise noted. Indexes are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested in directly. Data contained herein from third-party providers is obtained from what are considered reliable sources. However, its accuracy, completeness, or reliability cannot be guaranteed. Data is as of the date noted and subject to change. Investment advisory and financial planning services offered through Summit Financial LLC, a SEC-registered investment advisor doing business at Great Lakes Private Wealth. Summit Financial LLC does not provide tax or legal advice. If you require such advice, you should contact the appropriate tax or legal advisor.